welcome. You're watching our special coverage of the first quarter review of annual policy statement for 2008-2009, and we're already beginning to get the news. As you can see that, George, repo rate up 50 basis points to 9%, and CRR is up 25 basis points to 8%. How do you take that?
Well, it's going to be taken fairly negatively by the market. I think we are going to see yields move up. Just before we came in, it was at 9.22%. This is the yield on the 10-year benchmark bond. We can expect yields to move sharply up from these levels. And again, the CRR hike of 25 basis points, it was partly expected by the market, but to the extent that liquidity in the banking system is already tight, this will again be taken as a huge negative by the market. We will see call money rates, which are presently just under 9%, move back up to the 9%, 9.5% levels very, very easily.
Right. We've also got a lot of reactions coming in. First, let's tell you who we've got for us, for you here. We've got Darius Kowalczyk, Chief Investment Strategist of CFC Seymour, joining us from Hong Kong. We've also got Saugata Bhattacharya, Chief Economist, Axis Bank, also joining us from our South Mumbai studios, and of course Rahul Arora, Stocks Editor, who's in our newsroom, and George, our Banking Editor. Rahul, first take, any impact that you see on the markets?
Rohan, I think it was coming, like George just said. You saw the 10-year bond yields move up, and I think the performance of ICICI Bank, especially with what they've been saying over the past few days, if we just looked at the stock price performance of ICICI Bank and the interest rate sensitives as a whole, in fact, the bank's real estate and auto indices cracked in the last 15 minutes in the build-up of this, about 1.5 to 2.5%, and the Sensex, as I'm reading on our screens, is already down about 400 points. So initial reaction is that this is more than what the markets would have bargained for, a 50 basis point hike in repo rate hike and 25 basis point hike in CRR. We are already seeing interest costs affected by corporates in their profitability in the quarters in progress, but I think initial reaction is that this is negative. This is more than what the market had bargained for, and you're seeing the impact on a lot of those interest rate sensitives, ICICI Bank particularly, in the build up to this one.
Right. Saugata, can I bring you in here? How your first reactions on both and the CRR and the repo rate hikes?
Firstly, the CRR was a little unexpected. We had expected a repo rate increase, especially after the data that was released yesterday in the macro and monetary policy developments. We had expected a CRR hike, that the probability had increased. I think that the RBI has taken a lot of criticism for being behind the curve on monetary policy, and I think this is the corrective measure that it feels that it needed to have been taken to stop any further inflationary expectations increasing. And they've done it. But I have a feeling this might be a little overkill on the CRR side, because especially given the kind of negative liquidity that we have seen in the banking space now, and we also expect liquidity to have been relatively tight even without the CRR cut. So there's a lot of money extraction from the market.
Saugata, what kind of drain do you see in terms of money in the market, money supply in the market?
Well, the total deposits now are about 33 lakh crores. So a 25 basis point hike in the CRR is what? Around about 8,000, 9,000 crores. With liabilities, it would be more than that. And I don't really know what date the CRR would take effect. Presumably somewhere around the end of July, August, or some such date. So that's that much money out of the market, and given the kind of short-term credit build-up that we've been seeing to the oil marketing companies and fertilizer companies, this will place some manner of demand on banks to cut down on some other maybe productive investments.
We'll come back to Saugata in a second. Darius, further tightening in the overall monetary environment, where markets have already reacted negatively, down 400 points now. How's it looking to you from there?
This is exactly what we have expected, because the inflation picture in India has deteriorated so much that the central bank had to act more aggressively and not wait until the situation sort of translates into higher inflation expectations. Plus, we had yesterday the comments from RBI about the negative impact on inflation of fiscal policy loosening. So we are not surprised. However, most investors anticipated only a quarter percentage point move in the repo rate, and therefore we had a negative reaction in the market. I believe that there will be a sort of short-term boost that the rupee will gain from the fairly aggressive tightening, and we are looking towards it moving to the 41.5 level against the US dollar.
Right, Darius, do you expect these actions to actually possibly end here for the time being, or do you see further monetary policy action coming from the Reserve Bank of India before the end of the year? And again, what is the impact that you see this having on the GDP growth for India?
I think that unfortunately this is not the end of the cycle because according to our estimates wholesale prices will peak in the third quarter around 13%, so there will be another 1 percentage point of increase in the key inflation rate, and in order to prevent this from influencing negatively inflation expectations, the central bank will unfortunately have to move by, we think, another 50 basis points over the course of the second half of this year. And there has to be an impact on GDP growth because the money supply in the banking system is fairly tight, and lending ability will be reduced again. So the slowdown in lending growth will definitely impact investments and to some degree also consumption, and therefore second half and maybe first half of 2009 will see somewhat slower GDP growth that we would have had otherwise.
Dinesh, if I were to kind of quickly ask you a question about how you would contrast this move with what's happening in the region, are we running ahead, as Shogata just said, and tightening too far, or are we broadly in step with what's happening elsewhere?
Well, it depends on who you are comparing yourself to, because China, for instance, has front-loaded their monetary tightening in the second half of last year and has almost not moved this year, while some other economies, such as, for instance, India, is moving gradually towards tighter policy. But I think in order to compare with the region, you need to look at the real level of interest rates, and by this measure, India is sort of in the middle of the pack because inflation has jumped so fast and so high that we are still at fairly substantial negative real interest rates. So I think India is kind of, in terms of those real rates, in step with the region.